So good morning, everybody. Welcome to today's class. This is Options Animal 3.4, the bear call. I am Eric Hale, instructor with Options Animal. It is December 31st, 2016. Happy New Year, everybody. Here's to a happy and safe, prosperous 2017. All right, so the class today is the bear call. And before we begin, we have to say the normal disclaimer, and that is that all rights are reserved and copyrighted to Options Animal, and the content of this presentation should not be considered a recommendation to buy or sell a security. All information is intended for educational purposes only and in no way should be considered investment advice. Options involve risk and they are not suitable for all investors. All rights and obligations of options instruments should be fully understood by individual investors before entering any trade. Bam. Okay, so let's start off with our agenda. So we're going to talk about the instruments that are used. We'll go through applying the bear call and some considerations. We'll talk about exit points. We will give an introduction to strategy adjustments. So yeah, it's just the point. We don't really cover adjustments until level 2, but anyways, we'll talk about the bear call and the Greeks. We'll talk about risk and then have some conclusions. So the bear call optimizes a stagnant or a bearish trend. The primary instrument is a short call. When you sell a call, now that's the opposite of a long call. So whenever you sell something in your head, you should be thinking, I have an obligation. Now, everything with regards to rights and obligations only involves one of two things. It's either buying stock or selling stock. And the way that you can remember is think in terms of what a long call is. A long call is a right to buy stock. If you sell a call, you would have to fulfill that obligation, the other person's right, should they so choose to buy stock. You, as the call seller, would be required to deliver stock to them. Therefore, your obligation with a short call is to sell stock. So we sell a call, we collect a credit, and then we have an obligation to deliver stock. That strategy makes money in a bearish trend, a stagnant trend, even a slightly bullish trend. Not a very bullish trend, but a slightly bullish trend. As long as the short call expires out of the money. Technically, we can have it go in the money a little bit and still potentially close the trade for a profit. Now remember that we sell at the bid price and we buy at the ask price. And I always say if you get confused, just remember you get the short end of the stick. So when you're selling something, you sell at the lower price. When you buy something, you buy it at the higher price. Now, those of you that are paper trading have realized that you can game the system and you can probably find a price somewhere in the middle. My suggestion is that you trade at the natural when you're paper trading. The natural is the bid price or the ask price. There's a mid price too. So there's a bid and an ask price, and then there's what they call mid. And most paper trading accounts will allow you to get filled somewhere near the mid. That does not reflect reality. In reality, when you go to real money, you may not be able to get that price. You will always be able to get the bid or the ask, but sometimes you won't be able to get a more favorable. And I would rather, when you're trading, that things got a little better for you when you went to the real world, as opposed to things getting worse. So when you're paper trading, stick at the bid and the ask. When you go to real money trading, know that you can probably get a little bit better pricing, but not always. So the other component here is a long call. So the long call gives you the right to buy the stock, and it optimizes a very bullish trend. And of course, we buy at the ask price. And so the purpose of the long call in this trade is it is our source of risk mitigation. So the primary instrument, the major source of profits, is the short call. We add the long call because it limits our losses. With a short call, our risk is infinite. Buzz Lightyear, to infinity and beyond. But it's going down. You know, Buzz Lightyear flies up, right? At least that's how I envision it. But infinity to the downside. And we don't want infinite risk. A naked call, I think it's important to understand how a short call works as a component. Think of it as like a Lego block, but you would never have a short call alone. Maybe you do. If you do it, you're on your own. You'll notice that we don't advocate, you'll never hear a coach talk about doing a naked short call. Personally, I do not believe that anything with infinite risk is worth trading. So short stock and short calls have infinite risk. I think it's always prudent to just go spend a nickel and buy that long call if you want. If a short call is really, really, really what you want to do, go spend the nickel to buy a long call way out of the money to mitigate your risk. You'll appreciate it from a margin standpoint, but you'll appreciate it more if the stock explodes to the upside. So naked call, we protect ourselves by adding the short call in. So depending on where that is. So we're going to sell a call at a lower strike and then buy a call at a higher strike. And the net difference between those is a credit, because the one that's closer to the money, still out of the money, but closer to the money, is going to be more expensive than the option that's further out of the money. The risk is the difference between the strikes less the credit that I received. The way that you work that out, so I don't memorize these formulas, I figure them out every time. So what's my right, what's my obligation? I have the right to buy the stock at 195. I have an obligation to sell it at 190. So therefore, my maximum risk there is $5. However, I get paid to do this trade. There's a credit that I receive. So my maximum risk is going to be the difference between my right and obligation less the credit that I receive. So that's how you figure that out. So it's the difference in the strike prices minus the credit that I received. And the max profit is that credit. My hope when I place this trade, or my plan when I place this trade, is that all of the options expire out of the money. All of the options expire out of the money and I keep my credit. And that's your primary exit, is to have everything expire out of the money or close early. And we close early using what we call the 50-50 rule. If you're not familiar with the 50-50 rule, please allow me to show you. And remind me to post that other spreadsheet on the calendar from the class before. So this is let's use this as an example. So I'm going to start with a call at 190, and I'm going to sell it for 345. And then I'm going to buy a call at 195, and I'm going to pay, so it's a negative because it's a debit. I'm going to pay $218 for it. And if I click this button right here, total, bam, it's going to give me the total. So that is a net credit. So credit, which is equal to my profit, right? That's my max profit. What's my risk? My risk is I have an obligation. I'm going to get paid to sell at 190. And I have an obligation to buy there, okay? So that's the spread, but I do get to collect the credit, so I add that in. So my max risk, I can lose 373 on this. That is the maximum risk that I can lose. My expected duration of the trade, we're not saying there, but let's say the duration of the trade is 30 days. So roughly 30 days is about when you would do one of these. 21, maybe 45, maybe plus or minus or so, but 30 typically. So my return on risk, we talk about ROI. We use the phrase ROI a lot, and that's fine. You can use ROI, but it's really risk. Return on risk, and we can get philosophical here and talk about return on capital employed. If talking about secondary exits, that's a different discussion altogether. But return on risk is the right term, especially in this situation, because you're not actually investing this 373. Depends on whether you have a cash account or margin account or an IRA. depending on what, or an RSP, depending on where you are, depending on what kind of account you have here, you're going to be reserving a certain amount of capital. So it's going to come away from your buying power, but it's not, it's technically, we'll just call it risk. So return on risk on this trade is going to be, and I'm going to put a negative sign so this ends up being a positive, this divided by this. So this trade is a 34% return on risk. Now, at Options Animal, we like to use the concept of annualized return on risk for two different reasons. What annualized return on risk is, so let me show you the calculation. It's the return on risk times 365 divided by the duration of the trade. And what this is telling me is that if I were doing this style of trading day in, day out for the entire year, I would make 14% if it was working for me. So it gives me a perspective. One of the things it allows me to do, and I use the example, if I have two trades, one that makes 5%, one that makes 20%, they both have about the same risk. Which one do you want? You're going to say you want the 20%, but the truth is you don't know enough to answer the question. If I said the 20% requires you to be in the trade for a year, the 5% trade is a week long. Well, geez, in a week, I can do that 52 times a year. 5%, that's 260%. If I did that every single year, annualized is 260% versus 20% annualized. So the 260%, the 5% trade, which is 260 annualized, is the better trade. So that's one of the reasons. The other reason why we use this is I use this as a primary exit for me and to determine when I'm going to get out. So two primary exits. One is to allow it to expire worthless, or if I can exceed my annualized ROI. And I use the 50-50 rule. So the 50-50 rule. If you can reach 50% of the profit in 50% or less of the expected duration, close the trade. So let me show you an example. So let's say that in, say, 15 days, I was able to get, say, 65-cent credit. So I could close this trade. I could buy the trade back. I sold it for 127, and let's say I could buy it back for, what does that work out to be, 62 cents or 63 cents? And then I'm going to be left with a 65-cent profit. So would I do that? Yes. Well, let's see. Let's look. So the risk is actually still going to be the same on that trade. It's still the same spread, same obligation. So my risk is still the same. So I can drag this formula over there. It's going to calculate that now my return on risk is 17%. So that's about half of the return on risk. But the key is I'm doing it in half the time. So my return on risk on an annualized basis is actually $424. So that's pretty darn good. So, I mean, is it worth trading, closing for 65? What does that mean? Well, you're out of the trade in 2 weeks and you are able to free up that capital and go do another trade if you want to. I mean, who knows what's going to happen in the next 2 weeks? Where do you think the stock's going to go? Now, there's a certain point when this doesn't make sense, and this is why let's say that you can make 10 cents, and I don't know if this is going to work out, in one day. Yes. So if you, oh no, that's $10, 10 cents. Yeah. So if you make 10 cents in one day, on an annualized basis, that's more than twice the annualized ROI. Does that make sense to close the trade for 10 cents? Heck no, it probably won't even cover your commission. So that's why I use this 50-50 rule. So you want to be 50% of the profit, so about 65 cents in this case, in 50% of the duration of the trade or not, a duration of the expected duration of the trade. So if you can make about 65 cents would be my target for closing the trade. If I can make that in less than 15 days, I'll close the trade. If I can make it in 7 days, all the better. My annualized ROI is double. So that's the 50-50 rule. Make sense? Any questions? Seeing none, I'm moving forward. All right. So yeah, there you go. So we could expire worthless. In this situation, all of the options need to be out of the money. So when we talk about the max risk, that's sort of worth discussing, I guess, at some point in this presentation. Now is just as good as any. If all of the options are out of the money, what happens to the trade? Oh, wait, now's when I'm asking you a question. What happens if all of the options are out of the money? Primary exit, everything expires worthless, everything's great. What happens if all of the options expire in the money? So now the stock's trading down here someplace, or technically higher because the option chains are upside down. But let's say the stock's trading above 195. What happens? You sell stock at 190, you buy it at 195, you take the maximum loss. Well, I'm assuming you didn't adjust. You're going to take the maximum loss. What happens if the stock expires somewhere between the two of these? Well, think in terms of your obligation and your risk. Not necessarily. It's possible if it expires between those two, your trade does not work. Because what would happen if the stock expired like right in the middle between these two? You're going to sell stock at 190. Oh, but wait, I have a long call at 195. No. The stock is lower than 195. So that expires worthless. So you will be assigned at 190 and you will have short stock at 190. And if you have a margin account, you'll end up with short shares. If you have a cash account or an IRA, your broker will probably just close the position out for you and show a net loss in your account. But in a cash account or a margin account, on Monday when you come look at your account, you're going to be short shares. You're going to find short 100 shares times however many contracts you had. And think in terms of what just happened to this trade. So you placed this trade because you were bearish or stagnant. Well, if the stock is now moved up to 190 or past 190, 192.50, let's say, it has been bullish and you have been wrong. And you're in a short position. And what does Murphy's Law say that's going to happen on Monday? What will, according to Murphy's Law, will the stock be higher or lower? The stock will be higher according to Murphy's Law, and you will book more loss than the maximum loss we just defined here. Because on Friday, when you have no option, no potential to be able to, you have no potential to be able to make any sort of an adjustment over the weekend, and the stock can still trade in after hours. And then who knows what's going to happen on Monday. By Murphy's Law, the stock's going to be higher. So absolutely essential that you understand your rights and risks and obligations before the trade expires. And you're making sure that you're adjusting before the trade expires. If the stock has gone anywhere near the money, it may be prudent to close the entire trade ahead of time or already adjust into the position that you want to be in, following the plans that we discuss in level 7 on adjustments. But I think it's important to understand, because I actually had somebody come to me with one of these credit spreads and say, you can lose more than the risk. And I said, absolutely impossible, you can't. And he said, I did. I'm like, impossible, you can't. And he said, I did. And what happened was he got assigned, and over the weekend the stock moved and his loss was significantly larger, which is true. But technically, as of Friday, that trade was no longer in order and no longer in place, right? So it's a different trade. But so important to understand, if the trades go against you, that you need to know how to make the adjustment ahead of time. It's important to make that adjustment ahead of time. So secondary exit, either close and take a loss to minimize your loss, or adjust into another spread. And this right now, ladies and gentlemen, is an unacceptable secondary exit. So we'll talk a little bit about potential secondary exits but really we cover them more in level 7. And part of the reason why we don't go in deep dives is because you need to know everything up until level 7 to be able to understand the adjustment. So I'm telling you this because I see people set up trades, say, hey, Eric, take a look at my trade. And the secondary exit plan, which I believe is, if not, it's close to the most important thing. It's either number 1 or number 2. I think doing your due diligence is actually the most important thing. Fundamental, sentimental, technical analysis. The next most important thing is your secondary exits. What am I going to do if my trade goes against me? And saying adjust to another spread is crappy. It's a cop-out. It's a terrible secondary exit. And if you catch me or another coach doing it, call us on it. Say that's not acceptable. What's the secondary exit? And we should, you know, it's okay if you've done this for 10 years and you know what the secondary exits are off the top of your head and you already know what you're going to do. That's fine. But the reason we define secondary exits is secondary exits will impact time, risk, or capital, or a combination of all three. So can you do the time? Can you increase the risk? Can you add more capital to the trade? Or all three? And the time to figure that out is before your ship leaves the dock. That's when you determine if you need a life jacket and maybe a lifeboat before you leave the dock. And guess what? If you can't do the lifeboat or the life jacket, then you don't leave the dock. Go do another trade. So primary exit on this is everything expires worthless. And you can either close early to capture profits using the 50-50 rule. Remember, we just talked about that. Gave the example. There we go. That example there. So using the annualized ROI as a target, the 50-50 rule. So 50% of the profits and 50% or less of the trade, close the trade. That's a primary exit. Stock trend stagnantly, probably going to be your primary exit because this trade works in a stagnant trend. It actually works in a slightly bullish trend as well. But let's assume that your primary exit is to have everything expire worthless. If the short call, which is at the lower strike, is out of the money, then the trade should still close at a profit. You can choose to close early because if, let's say, you thought the stock was going to be bearish or stagnant, and you place this trade, now the stock comes up close to your short, you may choose to say, hey, I don't want to risk that going in the money. I'm going to close now, take whatever profit I have off the table. Or you can adjust into another spread trade, which we don't really go into all the details here. Like I said, that's level 7. So if it goes bullish, that would be adjusting into another spread trade. So we don't talk about those adjustments, and there's a gamut of them. Level 7, we cover them. Just focus on the trade for now. In your paper trading accounts, maybe taking a loss, or you can get creative and try thinking of other things you might do. Adding long calls, rolling out further in time, proactively turning it into a covered call is a hint. Let's see. What do you do if you want to manage your short calls? And is that about if you want to manage your short calls, or is that about it? I don't know what you mean by manage your short calls. When would you start to adjust the trade as the underlying approaches the short call? Well, that's a level 7 question, Michael. But ideally, for me, the best adjustment on this is to convert into a covered call. You've got two components. You've got a short call and a long call. The short call is losing money as the stock going up. The long call should be making money. So the long call is making money for you, yes, but the short call is losing more money. If you can add the stock and convert this into a covered call, the best time to do that is when the stock hasn't gone through the short strike. So this is why defining those secondary exits ahead of time are important, because the time that you would want to buy the stock proactively, and we're talking about level 7 here, would be to buy the stock when the stock hits the short. So when the stock goes up to 190 in this case, that would be the time to adjust it, to convert it, especially if your sentiment was that it's going to continue to go higher. As a minimum, you want to do it when the trade switches between being theta positive and theta negative. And I'll show you that in a second. That, for me, is the absolute critical juncture on when you decide to adjust this trade. when it is no longer a theta positive trade, when it becomes a theta negative trade. Yes, this trade does become theta negative, and I'll show you in a second. By closing the trade. When I say, the 50-50 rule, if you can capture 50% of the profit by just closing the short call and leaving the long call in place, heck yeah, do that. Because then you've got a lottery ticket. Now, what that means would have happened is the stock has gone very bearish. In order for that to happen, in order for you to get enough profit from this to offset, the losses there, means the stock's gone very bearish, and that long call is way out of the money. And yes, I mean, if it don't close, the short call's a penny. I'm sorry, the long call's a penny. It's a nickel. It's not worth the commissions. Just leave it on there. It's a lottery ticket. But do be careful and don't forget that it's there. True story. I had this happen on a bull put. So I did a bull put on GE, and GE went kind of stagnant, and I did about a 30-day trade and basically went sideways for about 30 days. And I said, well, I can capture most of my profits on a Monday. So I closed the trade on a Monday. And I said close the trade because in my head I closed the trade, but all I did was I closed the short position. So I'm talking about a bull put. So that's a short put and a long put. So I closed the short put and was able to capture like 85% of the profit because the long put was way out of the money and it was close to expiration. I just forgot about it. And in my head, the trade was closed because that put was basically worthless. And I wasn't going to pay the commissions to close it. Now, some brokers don't charge you commissions, but if it's $5, who cares, right? If it's a nickel or less, it's a lottery ticket, right? I'm just going to leave it on there, see what happens. Well, guess what happened with GE? GE made like a huge move, and that long put went in the money. And I had completely forgotten about that long put. And the same thing could happen with this trade. If you close the short call, you still have the long call. And now let's say the stock turns around and goes up. So now your long call's in the money. So what happens when a long option expires in the money? It's exercised. Now, if you call your broker and said, hey, listen, just net me out. I don't want to be exercised. Just close the trade for me. They'll buy or sell the stock after hours and just credit your account with whatever. You can tell them that ahead of time, but I didn't. And so what happened to me in the case of that bull put on GE is my short put was gone, my long put was in place, and then GE made a huge move down. It moved like 8% in like 3 days, and my long put went in the money. So Monday, when I opened up my account and looked at my platform, I'm like, what the heck is that? I had short shares in my account. Because what is a long put? A long put is the right to sell stock. And so if you haven't taken the bull put, I apologize, but it still is in this level. That's the bull put class. So the long put was assigned. And I ended up with short shares in my account. And I was like, I was about to call I'm calling my broker because I'm like, how the heck did I somebody hacked my account and they sold GE. I knew it. The Russians hacked. No, I didn't know it was a Russian. But I literally swore that somebody hacked my account and they must have my password and they're shorting shares in my account. But it was me. I forgot that I had the long put in place. So the same thing could happen on this trade. And that is that if the long call, let's say you close the short call, the long call still exists. And if the stock, you did this when the stock was going like this. Well, if it turned around and you close the short call and all of a sudden it goes like that, which could happen, right? The long call goes in the money. What happens if the long call expires in the money? You have no short call in place, just the long call. What happens? You buy stock. So assuming you have the cash and the capital to do it, then, or the margin, you'll end up with 100 shares if that long call expires in the money. Now, that might be a good thing because if the stock's been going bullish, that might be a good thing. And it worked out for me in the case of GE, that GE had gone down, and luckily it continued to go down over the weekend. And so the trade was profitable for me, but I was, making money by accident is not a good thing. So Does option? Yeah, of course it does. Net position Greeks. I'll pull up Options House in a second and show you. We'll pull one of these up. Anybody got a stock they're bearish on? We can do it with that. So the bear call combines a short call and a long call. The short call is placed out of the money but closer to the money, and the long call is placed at a higher strike. So when we're looking for equities, we want to find equities that we think are relatively weak. I do caution you on trading bearishly, though. This is there's a concept out there called short squeeze. And what short squeeze is when traders who borrow stock and sell it with the hope that the stock is going to go down, then they're going to buy the stock when it's lower, and they'll net the difference in the profit. So short sellers, when there's too many short sellers, it can actually have the opposite impact on a stock. And so what'll happen is, let's say, stock's moving around and it starts going down and down. So people say, hey, bearish, I'm going to go borrow some shares and sell them. The stock goes down, down, down. Then what happens is people start taking profits. The short sellers are making money. So the stock, and how do they close their short position? How does a short seller close their short position? They buy to close. They sold to open, they're going to buy to close. So the stock is in a downward path. If people start buying the stock, which is what they're doing, the stock stops going down. So then some other traders say, oh, it found support, so I'm going to close my short position and I'm going to buy a stock. So the stock starts moving up again. Now the stock starts getting up close to where the short sellers sold it, and they say, oh no, I'm not making money now. I got to close my position and just get out at a break even, and the stock goes higher. And then some of the short sellers are really freaking out now because they're losing money. And by now, some technical traders have said, wait, the 5, the 10, the 20, the MACD, the RSI crossed over bullish signals. Let's buy the stock, and then it goes higher. Then the short sellers freak out, and they all just, the heck with it. Get me out. I'm losing money. I can't take this because I have infinite risk. They buy all their stock, and the stock goes higher. That's short squeeze, and it's very, very real. I've seen it happen. So I always say good things can happen to crappy companies. So be careful when you're trading bearishly. I personally don't normally enter a very bearish trade. I might do this because this is stagnant to bearish and it has some flexibility, but beware of, you may be absolutely right. It is a terrible company, terrible fundamentals, technicals are bearish. It can turn around and go bullish for reasons that are not, it doesn't make sense. It's a terrible company, and the same thing happens the other way too, by the way. A really, really good company is going bullishly, and people say, I'm going to take profits, so they take profits. It's still a good company, but because they decide to take profits, the stock stops going up. And then other people say, well, it's found resistance. I'm gonna sell my stock now, and then the stock starts going down. And even though it's still a good company, that happens. Dead cat bounce. Yeah. All right. So we want to generally find a relatively weak stock and one that you think is going to be, maybe when you've seen levels of resistance, and I'll show you my favorite example of resistance. Where's what happened to my Windows bar? Oh, there it is. My Windows bar is not. EMC, and this is, so here's a graphic I like to show when we talk about technicals, support and resistance. This is an example of EMC. This is, each bar is a 5-minute. So this is 1, 2, 3, 4, 5, 6 days. And I remember being home and watching this happen here. So this is 1 day. These are 5-minute bars. And I have never seen, well, I guess I have seen it, but I mean, this is a classic example of resistance. Bam, 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 bam. We're not going above 20. No way, no how. The stock is not going to go above 20. And this exists for a very, very real reason. Support and resistance, I think, are some of the best technical indicators, because some trader, maybe multiple traders, have good till canceled orders for 20. They're going to sell at 20 until the cows come home. And this stock came up and tested 20 days and days and days. So selling a call, where do you want to sell the call at 20? Do you want to do it a little bit higher, 21 or 2050? I did. I was doing bear calls until eventually it did break through, and eventually it will. And EMC, it eventually will go higher. But you'll see these levels of support and resistance. They're very, very real things. So if you see, something like that happen where stock consistently has resistance and you believe it's going to be there, a bear call could be a good trade. The short squeeze. Okay, yeah, this is being recorded, so yeah, if you want to go back and watch the recording. So let's see, preferably 30-day. So we want credit spreads generally 30 days or less. This comes down to there's two things for this. Your crystal ball, which is your ability to see in the future, is generally better over 30 days than it is for, say, 60 or 90 days. The other reason is we're taking advantage of that accelerating theta decay. So when you look at the decay of an option, if you watch it over time, here we're at like 120 days, and stock's not moving, implied volatility is not moving, just the theta decay. Time's going by, and the value of that call is going down, down, down. So 120 days, 90 days, 60 days, 30 days, boom, 0 days. So in that last 30 days, bam, you can get when you and go look at an option that's right at the money, 100% of the value is extrinsic, has no intrinsic value. It's not. Look at a 30-day, 60, 90-day. Look at the same strike that's at the money but slightly out of the money, and recognize that, hey, that 30-day premium, that's going to be gone in 30 days. And compare that to a 60, 90, 120-day option. And so what we want to do is take advantage of that. In this situation, we're taking advantage of that rapid time decay that happens in the last 30 days. Now, some people might be thinking, well, if 30 days is good, 7 days is better. And I generally will close these trades a week before expiration. A lot of crazy stuff happens in the last week of expiration. And so trading weeklies, I do not believe, and Jeff has done a whole bunch of back testing on actual option pricing, showing that it's difficult to price options over the last week. The implied volatility for short-term options tends to be very high and tends to be mispriced. So doing these, you can use weeklies, but my suggestion might be do 2 weeks, do 14 days, and close them in 7 days. But doing that last week expiration, there's a lot that can happen in that last week. So be very, very careful when you trade weekly options. Yeah. So if you want to get to 45 days and there's a 45-day, there's a weekly there. Now, another caveat with using weekly options is that not the implied volatility, the bid-ask spread, which is the tax that you pay to the market maker, is wider on weeklies because the liquidity is lower on weeklies. Now, I envision that eventually there will be no such thing as weeklies and the liquidity will get better. But until there's more volume on them and more trading on the weeklies, I usually stick with a monthly. That's my first go-to. I avoid weeklies if I can, but surgically here and there I will do one. In fact, if you were in the class earlier, somebody asked me at the end of the class in the live open forum session about a bull put that I did using weeklies. So I did them 14 days or it was 14 days, I think, or something like that before expiration. So occasionally I will use weeklies, but be careful with weeklies. So we want to place them above resistance. So remember, resistance is what keeps you from going up. Support's what keeps you from going down. So in this situation, we're expecting resistance. So we want to sell calls up in this range where we expect the stock not to go higher. You want to be careful about fixed news events. So when there's something coming up, earnings event, product announcement, something like that, these trades look very attractive. And the same is true for bull puts. Both are credit spread. So the bear call, this is the bear call. When an event is approaching that the market expects will drive the stock bullishly or bearishly, it doesn't matter which way, the implied volatility goes up. So implied volatility, as the name would give you the indication, it is the zigzagginess that's expected to happen in the future. That's what implied volatility is. And so when an earnings event is coming, we expect sometimes a big zig or big zag, maybe not many zigs and zags, but at least one big zig and zag around the earnings event. So implied volatility goes up, which means option pricing goes up, which means if you're selling options, they look very attractive. So this trade will look good before an earnings event, which may be a caution for you. In fact, it is a caution for me sometimes when I look at a credit spread and say, wow, that credit spread's huge. That looks, what's going on here? Because sometimes here, I'm going to pull up my favorite Far Side. Sometimes that option premium is inside the dryer there, the cat food inside the dryer. You know, it's just, should I jump in there and grab that premium? Yeah. So sometimes when you see that option premium looks really, really good, that should be cause for you to take a step back and just look and see if it makes sense for you to get into the trade. And implied volatility, being able to interpret implied volatility is like playing poker. The analogy I always use is you're playing poker at a table. Somebody at the table is a fish. The fish is the person who's going to lose money. If you don't understand why the implied volatility is high, you're probably the fish, because everybody else that's playing poker knows why. So they're seeing cards you're not seeing. So just be aware. And sometimes the right trade is no trade. Now, the nice thing about this trade is it does have limited risk, right? So you can't, your risk isn't infinite. So, and it is a high probability trade. But beware of fixed events because they make these trades look good. And so this is a trade that you want not to make a very bullish move. So you need to be careful there. Yeah, don't want to be the fish, right? Yeah, if you play poker and you sit down at the table, within 20 minutes, you should be able to identify who the fish is. And if you can't in 20 minutes, you know who it is? You. So be careful on earnings. This says do not place over earnings. Now, once you get to the point that you understand, you know, everything in here can be broken. And I have done these before earnings. It's a little gutsy, but you need to understand the implications, and you absolutely must be 100% comfortable with your secondary exits because there's a pretty good chance you're going to need them. So doing these over earnings can be risky. Primary exit, expire worthless or capture profit. Secondary would be to adjust into another spread. See level 7. On a bear call, it would always be out of the money. Never would I do one in the money. And I'll show you why in a second. So here is an example of a trade that's been bearish and then looks like it's kind of been range bound, so it's kind of mediocre to bearish technically. Now, I have to add the caveat that we go through the slides and we're only showing you the technicals. We will have already done sentimental and fundamental analysis, which is boring and takes longer to do, which would have given us the same sentiment. There's nothing bullish on the forecast. Our expectation is that we're going to be slightly bearish to stagnant. So this takes advantage of a bearish move, the short call and a long call, right? So we would buy a higher strike call and sell a lower strike call, the 70 and the 75. because that is above resistance. So we've drawn resistance here and we're above there. So we would expect that if it comes up, it's probably going to test resistance and hopefully bounce off of it. And this is done, by the way, as one transaction. Some people do leg into trades where you may buy the long first and then sell the short, and make sure you do it in that order. And if you leg out, sell the short first and then the long, because you don't want to be naked. Because why? Because you can lose more than your dignity when you're naked. So this is looking at the days here. That's 122 days. That's 59 days. This is 24 days. So that we'd want to try and keep it shorter. So in this situation, we would sell the 70 strike for 24 days for a 90-cent credit, and we would buy the 75 for a 35-cent credit. The net credit on this is 55 cents. The risk is $5 minus the credit received, so that's $4.45 is my max risk. So this is making 12% in roughly 24 days. This trade would have a very high probability of working, probably somewhere around 80%, 90% chance of this trade working. Primary exit would be to expire worthless or close the trade early. Secondary would be to close at a theoretical break even or adjust. And that is when you've given back your credit. So here's a risk profile. If we look at, this is the risk profile of the short call. And of course, this is Buzz Lightyear going to infinity. Does anybody know why my iPhone just started texting me twice? Every time I get a text message, I get two of them. So this is Buzz Lightyear going to infinity and, you know, all the way down. So infinite risk on a short call, that should scare the daylights out of you. So we're going to add on a long call, which has, you know, infinite profit, woo, to infinity and beyond. And then by putting them together, we end up getting a risk profile that looks like this. So that's the short call. That's the long call. Our expectation is that the stock is going to stay below this point because it's an iPhone. No. Don't give me that. You and your janky Androids. Okay, so, oh yeah, so the break even is going to be the credit plus the strike. So in this situation, it's 70. This is a 70 strike, 55 cent. So 20.55 would be my theoretical break even. So let's look at another couple more slides here. So here's an equity that looks like we have resistance at 62. So we're going to do the 65.70. I can make an argument for doing the 60.65 too, potentially. No, that's the break even is going to be below resistance. So the 65.70 is a lot safer. So that's going to be 116.68, net credit of 48. The risk is 452. Again, this is a very high probability trade, probably 85% or more chance of this trade working. The primary exit is to have everything expire worthless. Secondary exit would be to adjust to another spread. Another example, and we're going to look at the Greeks here, and then I'm going to show you another way to look at the Greeks. But so in this situation, looks like it's found resistance around $18, maybe $17.50. So we're going to look at the 16.70. This looks a little, I would question whether or not we would do this one, but let's run with this example. So 16's right here. So just 3 days ago, it was, you know, it was above that point. So there would have to have been something that happened that you did get technical crossovers. So maybe you're running on the technicals. I don't know, whatever. So you're going to sell the 16 by the 17.50. That's a 250 wide spread on a 25-cent credit. So 125 is the max risk. This is a 20% ROI. The risk profile looks like yay. What do the Greeks look like? So if we look at the Greeks, we're going to take these as short because we're selling those. So this is a negative, negative, positive, negative, and then we take these as they're expressed because that's long, and we add up our Greeks. So this is a net delta negative. So for every $1 move, and the convention on these is this is be assuming one contract. So it is in actual dollars, not a per share price. So for a $1 move in the underlying, I'm going to make $14. If it goes down $1. Gamma is negative, so as the stock goes down, this delta is actually going to get smaller and smaller because this is a negative times a negative movement in the stock price would be a positive. Gamma tells me how delta changes, and so delta will become smaller as the price goes down for where it's trading right now, and I'll show you how this changes. But theta is positive. That's the primary driver in this trade, and it's relatively small right now, but it's going to accelerate as you get closer and closer to earnings. And Vega is negative, so an increase in implied volatility would hurt this trade. And Rho is negative, but of little consequence. So what are we looking at here? Okay, so here's another example of an out-of-the-money bear call. So stocks trading somewhere around $25.50 or so, somewhere between $25 and $26. And we do a bear call way out of here. $2 wide spread, 17-cent credit. Max risk is 183. So what happens what might happen to your risk if the ABC closed at $29? So you sold the 28, you bought the 30. What happens on Monday? We already went through this. If all of the options are out of the money, everything expires worthless. No problem. If everything expires in the money, you take the max risk. Your broker is going to buy and sell the stock. Technically, they're not going to do that in your account. They'll just net it out and you'll take the max loss. And no, you don't own the stock in this situation because what's in the money at $29? You are going to sell stock at $28 and the stock's trading at 29. So you would buy the stock at 29 and turn around and sell it for 28. The long call would expire worthless and you would have infinite risk. So it's important to remember to close these trades if they're near the money or especially in the money. You need to make an adjustment before. All right, so let me pull up. I promised that I would pull up and show you this. Well, so if you had bought it if you bought it at 28. Well, you bought it at 29, sold it at 28, and now the stock is at 31. Then that's a $3 loss right there. You'd have short shares and the stock's going bullish. So it's bad. You got to close it before. Because over the weekend, you can't. The stock can trade in after hours, right? I don't know. The last one I remembered was NVIDIA. Look at all that garbage. What was this all about? So let's say that we were bearish. Let's call, what's the top there? 120? I don't know if there's any premium at 120. So 21 days is about as short as I would like to do. And generally, you could go shorter, but let's see. Yeah, maybe there's premium up there. Not 240. All right, whatever. So 120. Yeah, there's premium there. Okay, I meant to do 24. Okay, so 120. 120, create a spread, custom spread. Sorry, Michael Vickers. I'm hoping that, you forgive me for not picking whatever crappy stock you wanted me to trade. All right. Okay, so Well, we're doing a bearish trade. Bearish is stagnant, so that's why I said crappy stock. It's not that you pick crappy stocks. You know what I mean. Okay. So here's a trade that brings in a 53-cent credit. My max risk is the spread, which is $5 minus the credit. So 447. I'm looking at a 12% return on investment in 21 days, 3 weeks. And probability of this trade working is about 84%. This is XYZ. So forget what equity we're looking at. I'm not bearish on any of these. I don't know. Vickers, what did you have? Honeywell or something like that? I don't remember. Where is that? Yeah, you had Honeywell. That was somebody's stock to watch for the year. You're bearish on it. Nice. I don't know. I don't remember which coach, but it wasn't me. But maybe true. Okay, so on this trade, if you're using technicals, you're saying, hey, 53, that's kind of a very high probability of this trade working. You could play with this trade and come down, roll it down a little bit, roll it down $5 if you wanted to, and you'd bring in a higher credit. Your risk is going to be smaller, but your probability still a 75% chance of working. Man, that's pretty darn. 110, 115 is probably not going to be good. Maybe. So 65% chance of that trade working. Break even is going to be at 111.48. So however you structure this, whatever, ideally you are confident in the level of resistance, right? Resistance is futile. But what I wanted to show you is the Greeks on this trade. So if you look at this trade, there are two lines. The thick line is the trade at expiration. This is where my short call is, so it's 110. This is where my long call is, that's at 115. And this is what the trade risk profile looks like at expiration. So on expiration, is it better to take more risk for a better profit and adjust as needed? This is less risk. My overall risk in this situation is lower. My profit is higher. My probability is lower. 65% probability is still pretty high. These three puppies right here, the profit, the loss, and the probability of making anything, those three things are always in balance. If you can imagine a graph that has each one of those on the axes, you can only get two good ones. So you can play with what makes sense for you. I like to trade in the 65% probability window, and that works out. About 65% of my trades close at their primary exit. 35% of my trades need to be adjusted. If I do 10 trades, 3 or 4 of them are going to need to be adjusted on average. I just know that. So you have to be, I don't care what trade you do, you have to be comfortable with your secondary exit. And frankly, loss as a secondary exit sucks. So I don't like loss. I want a trading plan, but what I wanted to show you on this is the Greeks. If you haven't seen the Greeks, the break-even number means if the stock moves up to 111. So break-even is right here. That's where the 111.48 is, which is going to be the short call, 110, plus the credit, 148. That's how you figure out where the break-even is. So 111.48 is the break-even, and that's right there. So that assumes, now, understanding the mechanics of the trade, short calls in the money, long calls out of the money, it is considered a theoretical break-even because you would have to close the trade at expiration. So this line shows where the trade is today. And so if the stock moved to 111.48, can I get there? If the stock moved to 111.48, right there, close enough. Am I making money or losing money? If I close the trade right there, do I close it for a break even? No, I closed the trade for a loss. No, if it went all the way to expiration, then I could hopefully, in theory, close it for a break even. But today, if I close it at that price, it's closing for a loss. So this line shows where the trade is today, and I'm moving up and down that line. Now that line is always moving closer to the thick line. So come expiration, this thin line will be indistinguishable. It'll do something that looks like this. So come expiration, I'm changing the scale down the bottom, so ignore that. But come expiration, this thin line will be sitting right on top of the thick line. That's what happens. This thin line is going to move closer and closer. And come expiration, you won't be able to distinguish between the thin line and the thick line. So this is where the trade lies today. So what can I tell about the Greeks of the trade? There are three Greeks that you can see from this graph. The first one is delta. So if the stock is going up and to the left, that means, so this is my profit, this is the stock price. So here's where the trade is trading right now. What happens today if the stock price goes down? Do I make money or do I lose money? If the stock price goes down, do I make money or lose money? Therefore, the delta is what? What is the delta of this trade? Is it positive or negative? It is negative. Delta negative, meaning that a negative times a negative is a positive. So a negative delta and the stock goes negative. Negative times a negative is a positive. I make money. More green. If it's sloping in that direction, up and to the left, the trade is delta negative. Now, delta is actually the slope of that line, the magnitude of that slope. So how steep it is tells you how high the delta is. What happens to the delta as the stock price goes down and down? And I'm asking you, what happens to the slope of that line? That's delta. What happens to the slope of the line as the price goes down and down and down? It's less. What is the delta right there? There's a number, 0. Because the stock price goes up and down. My P&L, see the P&L number there? Over there? See the P&L number? 148, it doesn't change. My profit and loss doesn't change. Delta is 0. Goose egg. There's no delta. So if delta is like this, delta 0. Now, there's some goofy stuff that happens out here, but is this trade, what's the delta out here? Is this delta positive or delta negative? Delta is the slope of the line. And if it's going up and to the left, it's delta negative. If it's going up and to the right, it's delta positive. Which way is the delta pointing here? It's still delta negative. The trade is still delta negative. In fact, it's either 0 or delta negative. And out here, something goofy, but it definitely goes to 0 way out there. So it's 0, it's negative, kind of small, getting bigger, getting bigger. The slope, the steepest it gets is right there. Then it's getting smaller, smaller, but still negative. Then it's 0. So I imagine you're sitting on a sled back in Canada and you're scooting off the hill and then you go zipping wee right down there as fast as you can as fast as you can. And then you hit the dumpster behind the grocery store and break your leg. Okay, I didn't actually break my leg, but I did hit a dumpster behind a grocery store. So this is where you're going really fast in here. And the trade is going fast too. So not a lot of excitement in the change in pricing out here. Not a lot of change in excitement. So somebody asked me, which is better? I don't mind being here, but you may decide you don't want to be there. You may say, hey, listen, I'd rather be up here. So the slope of the line, it's starting to get steep, but it's not crazy steep. It's steeper right here. It gets a lot steeper there. You're still kind of in the granny slope right about there. But if the stock price goes down, things are going to start changing. But out here, it's kind of boring, you know, right? I figured as much. You know, us that grew up in the north, not the Great White North, but close. I was New England. So back to this trade. So the delta is the slope of that line, and this line is going to be moving closer and closer to this line. Now, the other Greek that you can see on here is gamma, and gamma tells me how delta changes. Gamma tells me how delta changes. So delta is the slope. It's a little bit hard to see, but it's there. Now, just let me give you a couple rules of thumb. If the slope of the line is anything like this, so anything about frown, the gamma is negative. So gamma is negative all the way to here because it's kind of a dome, right? See, the shape of that curve is like this. So it could be like this or it could be like this, but if it's going like this, then the gamma is negative. Gamma is negative. So what does that mean? That means that as the stock price goes down, gamma is negative, stock price goes down, I'm going to multiply a negative times a negative, and then I got to add that to the delta. A negative times a negative is a positive. Delta is negative, but if I add positive to it, it's going to make it less negative. So as the stock price goes down, the delta is going to become lower and lower. Oh, am I doing the right way? Yeah. So the delta is going to become lower and lower. So as the stock price goes down, so here we are, and as the stock price goes down, it becomes more flat. And that's gamma because gamma is negative and it's impacting the trade. However, gamma, we already came out here and we said the delta. Which way is it going? It's still pointing that direction. So that means it's delta negative, right? We got that. But gamma is actually positive out here. So if gamma's a frown, gamma is negative. I mean, if the slope of the line, the shape of the line is a frown or a dome or a hat or whatever you want to call it, a toque, you call this your toque, this is this is gamma negative. Out here, it's a smile or it's a bowl or an upside down hat. If it's a smile, gamma is positive. So gamma is positive out here. So the gamma does trade going from gamma negative to gamma positive. The delta is still negative all the way in this whole range. Gamma is negative. Now remember, gamma is the slope of the line, so it changes. So that's gamma. So gamma, I don't really care about gamma. So I can look and see what I need right here on the curve. So some people get really excited about gamma. And let me tell you about when you should get excited about gamma. Gamma is the difference between delta. So if I look from here to here, what's the difference? Not very big. The difference from here to here, not very big, not very big, not very big. So it's not really exciting. So gamma goes from being negative to zero. If it's flat, and it could be like this or like this, if it's flat, there's no gamma. So gamma goes negative, 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 zero, then it goes positive, positive, positive. On this line, it's not really exciting. It's hard to see gamma. But on this line, it's a different story. What's the delta here? Do I make money if the stock price goes up or down? Delta's the angle of the slope. What is the angle right now? There isn't one. Delta's 0. And then when I get out to here, delta's something like 1 probably. So if I'm comparing here to here, what gamma is the difference in delta? Is there a difference in delta between here and here? Obviously not. There's no. Here and here, no. Here and here, no. Here and here. Is there a big difference? Yes, there's a huge difference. And then there's no difference, no difference, no difference, then a huge difference. Why is that important? Because as this curve line moves closer and closer to this thick line on expiration, what that means is that, the stock price is going up and down out here when you're close to expiration. Using weeklies, you're getting close to expiration. These are out of the money, stock price going up and down. My trade's not really changing. And then all of a sudden it goes near the money and the stock makes the same sort of move that it was making up and down a dollar, up and down a dollar, trade's not changing. Now all of a sudden I'm going up and down a dollar and my trade is going, whoa, holy crap. Your trade's making huge changes when you're near the money at expiration. That's why gamma is important. That's why gamma is important. And that's why I don't like to trade weeklies. I don't like to have short positions that are near the money close to expiration because small changes in the underlying make huge changes in your trade. Some people want to trade weeklies. That's great. Go for it. I don't like the risk. So we talked about delta. We talked about gamma. There's one other important Greek that we can see in here, and that is theta. So the thin line is always approaching the thick line. And if the thin line is going up, it is theta positive. If the thin line is going down, it's theta negative. So this blue dotted line shows me where the stock is trading today. What happens to this trade if nothing changes but time goes by? Stock just goes deadline. Do I make money or lose money? I make money. Which means, what is the sign of theta of this trade? Is it theta positive or is it theta negative? It is theta positive. True. So what happens when the stock price comes down to here? Now I've lost money on the trade, but what happens if the stock just stagnates there? So the stock actually goes up to say 115-ish. And then it finds resistance. So I thought resistance was going to be at 110. Well, now it's actually at 115 and the stock just goes sideways there. Do I make money or lose money with time? To answer the question, you need to remember the thin line always moves towards the thick line. The thin line always moves to the thick line. The thin line is moving up, it's theta positive. If the thin line is moving down, it's theta negative. Which direction is the thin line going? It's going down. Therefore, the theta is negative. Are you following me on this? Do you get this? Okay, this is kind of important. And people blow off these risk profiles. I've had professional pit traders tell me that these things aren't useful to them. To me, I can't imagine not looking at the risk profiles because I can look at it. I can tell you the Greeks. I can tell you the delta. I can tell you the gamma. I can tell you the theta like that. Let me tell you one other thing about theta. And that is here, the distance between here and here is related to, the distance between those two lines is related to the magnitude, how big theta is. You're welcome. So the distance between here and here. So think of this, between now and expiration, the thin line will be sitting completely on top of the thick line and will be indistinguishable. So between now and expiration, we're going to close this gap in the same amount of time that we close this gap. So where is theta the biggest? So theta is a speed. So it's dollars over time is what it is. So that's, you can think of it as I know people say delta speed. Delta's kind of a speed too, but so it is, theta is another, it's a rate. It's how many dollars you're making per time. So, and it's related to the gap between these two lines. So the bigger the gap, so think of this, in the next 21 days, I'm going to close that same gap in the same amount of time. Which one's moving faster? The one that has the biggest distance, because it's going to travel the same distance in the same amount of time. Therefore, it is moving very fast. The thin line moves towards the thick line. Did I say that? So what's my theta here? Positive or negative? Yes. Yes. That's exactly right, Stuart. It's still theta positive. I'm making money with time because it's going up, right? But do you think theta is going to be big or small? Well, look at out here, theta is 0. I mean, it may be pennies. It's still going up, but it's really, really tiny. And out here, basically, theta is 0. Right here, right at that short call, is where theta is the highest. And it is screaming high. What's the theta right here? Zero. Nothing. Then it moves a little bit more. And what's the theta right there? Very negative. So this trade is a strategy that a lot of people use because it's a lazy man's trade. I don't want the stock to do anything. I just want to sit back in my hammock and drink my cocktail drink with my flour and the straw in it out of a coconut. I just want to step on a Pop-Tart. You know what I mean? You just want to chill out and just let time go by. However, that's true all the way up until this point. Once you've gotten here, you're in a completely different world. And somebody just dumped a bucket of ice water on you and slapped you in the face and flipped you upside down in your hammock. Okay? Your attitude needs to change to that degree. Cold bucket of water on the face, okay? Flipped upside down in your hammock. Imagine the upset. That needs to be your mindset when the trade gets to this point. I have seen written from other trading programs that say this trade is always theta positive. Is this trade always theta positive? Is it always theta positive? Absolutely not. And it can be very, is it theta negative here? Yes. Is it very theta negative? Yes, very theta negative. What happens if the stock just stays right here? I'm going to take my maximum loss. This point right here. So closing at a theoretical break even, which is right about there, is important. But the trade is technically still theta positive right there. I'm splitting hairs right now. But right here, it's delta neutral. I'm sorry, not delta neutral, theta neutral, theta 0. But there, all of a sudden, it becomes very, very theta negative. You are in a completely different trade right now. And for me, so somebody asked, where do you adjust? Michael, you asked me a while back, and I said, I'll show you. Where do you adjust? For me, absolutely critical right there. When my trade is no longer theta positive. Is it okay to be here? Hey, listen, I was bearish to stagnant. If my fundamental, technical, sentimental analysis still gives me reason to be bearish, and it's important now at this point where the stock has come up to here that you reevaluate all your sentiment and say, do I still believe in that or has anything changed? Because one of those may give you an indication to make an adjustment. Because if you make an adjustment, the sooner you do it for the new trend, the better. So if I adjust this into a bullish trade, the sooner I do it, the better it's going to be for me. However, if I adjust to a bullish trend and then it turns around and goes bearish, then it's going to be worse for me. So right now, I'm evaluating my fundamental, technical, sentimental analysis and saying, is there a real cause to adjust? Right here is when my finger's hanging over the adjustment button. And right there's where I pull the trigger. and wish that I did it back here. Once you cross, this trade goes from being theta positive to theta negative, you are in a completely different trade. You are in a bad trade that lost money, and it will only get worse. You feel me? So being the guy in the hammock, no longer. You just got flipped out of your hammock, okay? That's what happened right there. You need to wake up and smell the coffee, and you need to get the heck out of this trade or adjust it. What if you just close the trade for a loss? Well, shoot, I just lost $100. Well, that's a heck of a lot better than losing 350. Unless you have an adjustment plan, which we talk about in level 7. Delta on this trade never gets negative, never gets positive, never gets positive. But this trade, which by the way is 1/2 of what other trade? So that is an iron condor, which is, I don't know if I'd want to do that one. Let's roll. Rolling. 105. No. Oh, crap. 10. 100. 95. Okay. I still don't know if I'd do this trade, but this is an iron condor. And what is the theta between the short strikes? Theta positive all the way between here. Out here, it becomes theta negative. Now let's go back to the top. Right there, what's the delta of the trade? Delta is the angle. It's measuring the angle. What's the angle? 0. So ideally, when we set one of these iron condors up, we are delta neutral, theta positive. Delta neutral, theta positive. Now, as soon as the stock price moves, the delta is going to change. So, right, what happens if the stock goes to here? What is the delta of the trade? Good. Very good. Delta negative, right? It's going in that direction. It's backwards. It's doubly backwards for me because I got to, when camera's back, well, it's just, my dyslexic brain hurts me. But if it's going up and to the left, it's negative. Well, think about it. If the stock price went up to here, what do I want the stock price to do? I want the stock price to go down. That's going to, I'm still not above break even, but I want it to come down. And what happens if the price goes down to here? Now, what is the delta of the trade? It's the angle. It is delta positive. So delta neutral right there, which is where I want it to stay. If it goes down too much, I want the stock price to go up because it's delta positive. And then if it goes up too much, it becomes delta negative. So I want it to stay here. This trade between here and here, what is the theta of the trade between these two lines? And what happens when the trade gets out here? It is theta negative. So what we just talked about on the Greeks applies to the bull put, applies to everything. I mean, every trade. So recognizing where the physics of the trade. So when we go through this and show you on this previous slide, what the Greeks are, that's true for this trade. The Greeks are true for the trade when it's out of the money. So the stock is trading below the short call. All of these Greeks are true. It's going to be delta negative, gamma negative, theta positive, vega negative. All of that's true, but it all changes once it gets up. Not all changes because it's still delta negative, but the gamma is now positive and the theta is negative. Those are the important ones. Vega is hard to see on this graph. So the impact of implied volatility. The rule of thumb that you can use on Vega is if all the options are in the same month, it's the opposite of theta. So theta is negative here, gamma will be positive. Theta is positive here, gamma will be negative. So if you want to get, it's difficult to see Vega and implied volatility in here in the risk profiles, but you can definitely see delta, you can definitely see gamma, and you can definitely see theta. All right. Would it make sense to adjust an iron condor from a bear call? Yeah, sure. I mean, that's if you believe it's going to be range bound, an iron condor. Now, I personally don't like to do iron condors on equities very often. I do them occasionally. I prefer to do them on indices because you get these things they call, I call them crazy Ivans. And that's a term that the submariners use, but because in a submarine, you can't hear what's directly behind you because your propeller. So in submarines, the Russians were known for making a right-hand turn because they could hear everything, around here on the submarine. They just couldn't hear what was behind them. And the American subs would go up behind the Russian subs, and they would, they're monitoring and they're recording the sounds and they're following them wherever they go. And then eventually, so the Russians would turn, they call it a crazy Ivan. And believe it or not, the Americans sometimes would slam into the Russians. My father was a submariner. And this stuff isn't, I mean, you can read about it in Tom Clancy, which is apparently it's true. So, but stocks sometimes will do this, right? But an index tends not to make that crazy sort of, crazy Ivan move. You can have weird things happen on equities that, even outside of earnings, you can have weird announcements and stuff like that that can make a stock make a huge move. So indices, I think, are better for iron condors. That's my opinion. Yeah, this trade does take, well, almost every trade you place is losing money when you put it on. But the nice thing about the bear call is it is theta positive. So it is the, the lazy man trade. You sit back in your hammock and drink your cocktail while you're letting time go by. But when it starts going, a stock starts going up, you got to be paying attention. And certainly the time to get woken up is when the trade is no longer a theta positive trade. Your whole premise on the trade changed. That's absolutely, you can debate whether you should adjust at the theoretical break even or blah, blah, blah. But once the trade has gone into a theta negative trade, your life is bad and it will only get worse. That's reality. You absolutely must adjust at that point. So simply stated, why does IV impacts theta? Because it makes the extrinsic value bigger. And when you think about in terms of options, what's happening to the extrinsic value? The extrinsic value of an option is always greatest when the stock is trading at that strike. So the extrinsic value of the short, which in this situation, the greatest extrinsic value is right here. And that's what's driving the trade, is the short position, because it's at the money and has the most extrinsic value. So when the stock price goes up or down away from the short call, the extrinsic value of the short call is going to get smaller, and therefore the theta is going to go down. Then you've got right here, you've got the extrinsic value of the long call. So if the stock drives to the long call has a negative theta and also has the biggest extrinsic value between the two of these. The extrinsic value of the long call is going to be biggest right here. So the long call is driving the trade. And the long call is actually helping to change the delta to be less negative, but it is also theta negative, so it's driving the trade to be theta negative. So that's, and as extrinsic value gets bigger, which happens when time goes backwards, which doesn't happen, which happens when implied volatility increases, is usually how the extrinsic value is going to change. Other than stock movement or time, when implied volatility gets bigger, the extrinsic value gets bigger, and then the gap between here and here gets bigger, which means your theta is going to be bigger. There's a little bit more physics to it, but that's sort of Michael's explanation or question. That's sort of the explanation right there. Yeah, IV does change the price of the trade. So increase, this is a Vega negative. It's actually Vega positive out here, but the Vega will never make money for you. In this trade, it's really driven by a Vega negative by the short calls or primary instrument. So you can never get enough Vega to make this trade positive. It does become Vega positive out here. It's Vega negative in here. So really the biggest concern with this, no, you can actually, even having implied volatility go up, you can still make money on the trade. You just need it to stay below the short strike. So implied volatility does impact this trade negatively, but this is primarily, I mean, you could do this looking for IV crush. So you're expecting implied volatility to go down, but that's generally probably not what you're going to do on this trade. This is mostly a theta and a delta trade that you're looking for the stock to go stagnant or bearish and time to go by. So implied volatility does factor into this one a little bit, but not really a Vega play in my opinion. So let's go to where we were. All right, so the bear call optimizes a stagnant to bearish trend using call instruments. Primary instrument is the short call. The risk limiting is the long call. The max reward is the difference between the two, less the risk, less the credit. I'm sorry, the max reward is the credit. The max risk is the difference between the two strikes, less the credit that's received. Secondary exit could be to close the trade or adjust into another spread, C level 7. So pick 3 equities that are stagnant, go do bear calls on all of them, write them out in your trading journal, and which worked, what didn't. If you want to see a bear call, for these directional trades, I do not recommend, I don't recommend stocks, okay? I can't recommend stocks. But the inverse and leverage ETFs are fine to practice with, to paper trade on. If you are looking for a trade that will go bearish or bullish, go trade the triple inverse and the triple direct of something like the FAZ, F-A-Z, Foxtrot Alpha Zulu, or the FAS, Foxtrot Alpha Sierra. So the FAS and the FAZ, one's triple leverage financials, one's triple inverse financials, and go do a bear call on both of them because one of them is going to go bearish, all right, or stagnant. Or they might both go stagnant. Those are not intended to be held for more than a day. Those ETFs, if you look at them, the float is greater than, the volume is greater than the float because most people, they're intended to be open and closed in the same day. They are made for day traders. And there's rebalancing that happens overnight and considerable slippage. So if you went out and bought both of those, bought the FAS and the FAZ, you would expect that you should break even, but you will lose money on both of them if you bought both of them because one's supposed to go up triple, the other's supposed to go down. There's a whole bunch of math behind it. I'm telling you this, if you want to paper trade the strategy to practice the strategy, go do a bear call on both of them, and because one of them is going to work and one of them is not going to work. But as an equity to trade, to learn the strategy, because it'll move quickly, go do that. But I think be careful about whether you want to own those. Yeah. The triple leverage, the inverse leverage, I'm not a registered investment advisor, so I can't tell you not to trade them. But they, next to trading equities, trading the VIX derivatives, there was actually talk by the SEC to ban triple leveraged and triple inverse ETFs from retail traders because people have blown up their entire retirement accounts not knowing what they're trading. And the way to figure something out isn't to go put on a few trades and see how it works. You need to understand it before you trade it. So be very careful, real money trading, but paper trading, I would encourage it. All right. And that wraps us up. Long class. Hopefully this was helpful. I appreciate y'all taking time out, and I wish y'all a happy new year and safe and prosperous, and wish you all the best. And I look forward to seeing you guys all in the future sometime. So if you have questions, feel free to reach out to us on live open forum sessions or come to the community website and ask your questions there. I look forward to seeing you in another class real soon, everybody.